All right, today we're jumping into a full financial deep dive on Molina Healthcare, that's ticker MOH. We're going to tear apart the numbers and really figure out what's going on with this company. So, here's the plan. We're going to start with a bird's eye view, get the lay of the land. Then we'll check its financial vitals, kind of like a health checkup. After that, we dive deep into the financial statements, run the numbers to figure out what it's really worth. And finally, we'll give you the final verdict. And really, this all boils down to one big question, right? With the stock sitting at about $137, are we looking at a hidden gem? Is this a huge opportunity that everyone else is missing? Well, let's find out. Okay, first up, Section 1. Let's get a handle on who Molina Healthcare actually is and what they do. So what's their deal? Well, Molina is a heavy hitter in the world of government-sponsored healthcare. Think Medicaid and Medicare. Their whole business model is built around providing managed care for low-income folks across, believe it or not, 21 states. They are a big, big player in this space. So digging into the specifics, they're in the healthcare sector, more specifically healthcare plans. The CEO is Joseph Michael Zubretsky. But here's what really jumped out at me, the major holders. You've got the Vanguard Group, Capital World Investors, and BlackRock. I mean, when you see the biggest names in the game, the Vanguards and BlackRocks of the world, putting their money here, that's a pretty strong vote of confidence. They don't just throw their money around, All right, so we know who they are. Now it's time for the fun part. Let's pop the hood and do a quick financial health check. We're checking the vitals. And just so you know, all the numbers we're about to look at, they're pulled straight from the company's public financial stats. No magic tricks, no smoke and mirrors. This is the real deal. First up, let's talk about size. The market cap is sitting at $7.12 billion. That's basically the total price tag the stock market has put on the whole company right now. But get this, while the company is valued at $7 billion, it's pulling in a whopping $42.84 billion in revenue. That is an insane amount of money flowing through the business. It just shows you the sheer scale of what they're doing. And out of all that revenue, what's left at the end of the day? About $1.18 billion in net income. That's the pure profit, folks, the bottom line after all the expenses are paid. Okay, so what do all these numbers mean? Is the stock cheap or expensive? Well, these valuation ratios are our guide. Look at the PE ratios. Pretty low. The PS ratio is tiny at 0.17. But the one I really want you to focus on is the PEG ratio. It's at 0.70. Now, a rule of thumb for a lot of investors is that anything under 1.0 can be a big, flashing sign that a stock might be undervalued given its growth prospects. And what about profitability and growth? Well, the return on equity is almost 20%. That's a really strong number. It means they're excellent at turning shareholder money into more profit. On top of that, revenue grew by over 11% last year. So yeah, the initial health check, I'd say it looks pretty darn healthy. All right, the vitals look good, so now it's time to go deeper, to really get into the nitty-gritty. We're about to look at the company's report card, its wealth snapshot, and its checkbook. First, let's look at the income statement. This is basically the company's annual report card, right? And what do we see? A beautiful upward trend. Total revenue, gross profit, and net income, they're all climbing. This is exactly what you want to see. Steady, consistent growth, year after year. Next up, the balance sheet. This is a snapshot in time of the company's financial health, what it owns versus what it owes. And again, it's a good story. Total assets are growing, and look at that common stock equity. That's the slice of the pie that belongs to shareholders. It's growing nicely too. The company is getting wealthier. And finally, let's check out the cash flow statement. This is the company's checkbook. It shows where the cash is actually coming from and where it's going. And the most important line here, operating cash flow, is solidly positive. They are a cash-generating machine. This is the lifeblood of the business right here. So, let's recap. We know what they do, and their financials look solid. So now we get to the main event. This is where we try to answer the million-dollar question. What is Molina Healthcare really worth? Not what the market says it's worth today, but its true underlying intrinsic value. And to do that, we're going to use a classic valuation tool called a discounted cash flow analysis, or DCF. It sounds complicated, but the idea is actually pretty simple. You just estimate all the cash the company is going to make in the future, and then you figure out what all that future money is worth to you right now in today's dollars. Now, of course, any model like this needs a few key assumptions. We're using a risk-free rate of 4%, a pretty low beta, which means the stock is less volatile than the market, and a market risk premium of 5%. All that gets us to something called the WACC, or the discount rate, of 6.2%. Think of the WACC as the hurdle rate. It's the rate we use to discount all those future cash flows back to today. And, drumroll please, here are the results. We ran a few different scenarios, a pessimistic bear case, a super optimistic bull case, and then our most realistic base case. And just look at this. Even in our worst case scenario, the value comes out to $331. But our base case, the one we think is most likely, it pegs the intrinsic value at a stunning $409 per share. Okay, so that brings us to the moment of truth, the final verdict. How does our calculated value of $409 a share compare to what you can buy it for on the open market? And here it is, the showdown. On the left, our calculated intrinsic value, $409. And on the right, the current market price, around $137. I mean, just look at that gap. It's not a small difference. It is a massive, massive chasm between what our model says it's worth and what the market is currently pricing it at. So, based on our DCF model, the conclusion is pretty hard to ignore. The stock appears to be significantly, profoundly undervalued. But, and this is a big but, this is where the real work begins. Our model screams value, but the market is clearly saying something different. So the question I want to leave you with is this: why? What is the market seeing that we aren't? What are the potential risks or headwinds that could justify this huge discount? That right there is the critical next step in any real investment analysis.